Okay, I want to give a little update on what's going on in the market. Here you go, Julie. I did this little slide here. This is the year 2010, 11, 12, 13, all the way up to 22, and then into this year. And we make money in real estate 5 ways. Income, meaning cash flow. It's, for those of you who want to remember something, it's the ideal investment. Income, meaning cash flow. Depreciation for the tax benefits. Equity, that's equity capture on that one, on capturing equity. Appreciation, which happens over time, and also forced appreciation, and then leverage. So I went back and I started looking and saying, where were we in each one of these years? Okay, and where are we now? Because here's the whole thing. Let me ask you this. How many of you are afraid of what the market's doing?
Be honest now, come on.
The current market, be honest here. Real estate, the whole economy. Who's worried about it? Okay. Now, keep your hands up for a second. Okay. Now, only put your hands down if that fear is going to stop you from investing.
Again, be honest.
Wrong way. Yours is up. I know it is. Okay, because that's the whole thing. Warren Buffett, and I always accidentally say Jimmy Buffett, but Warren Buffett he said, be greedy when others are fearful, be fearful when others are greedy. And right now, you saw how many hands? They're afraid. You guys here who had your hands up and doing that, you're smart enough to realize that now is the time to actually be investing. Okay, in the right things, obviously. You don't want to just be throwing money out there. But I went back and said, okay, where were we back in 2010? Okay, could we get income in 2010 on our purchases? Pretty much no.
Why was that, Darwin?
Why was that? I wonder what happened in 2008. I think most everybody in here is old enough to remember that. 2008, we had a big market crash. Go watch The Big Short. That's a fun one to learn about what happened. But at that time, everything shut down. Okay, everybody lost money. Okay, in 2008, 9, 10. It didn't have properties you bought then didn't have cash flow. Depreciation, it's got a dash on that because you had normal straight line depreciation. That changed in 2017. Why did it change in 2017? Trump tax cuts. That they added bonus depreciation, accelerated depreciation, which gave us huge tax benefits, huge for real estate. Great having a real estate investor as president. And then as far as equity capture, you could buy properties below market value. Kind of like having it appraised for 78, we're paying 70. Okay. Appreciation, you were having appreciation because the dip was 2008 and 9, and then it was flat and started going up. And then leverage. Here's the problem. There was no money available. You couldn't get debt. Cash was king. Okay. So people that had cash made a whole lot of money. Just to give you a little history, when was the last big crash? Anybody? Prior to 2008. Not close. 1986 is really when it crashed. 87 was when Black Friday, was it Black Friday? Black Thursday? Black Monday, whatever it was. But in 1986, they had 3 things. They changed the tax code, they deregulated the banks, and tax code, deregulated the banks, and oil crash. And those things killed real estate. Just so you know, then it was down. And in 86, Dallas was one of the hardest hits in the country. Do you know what the state bird of Texas was in the early 80s? the crane, because of how much building was going on. That crashed and it stayed down. Normally, they say it's either a V recovery, where it just goes down and back up. They say it could be a cup that goes down, could be a plate, takes a little bit longer. Well, in 86 to 91, it was a platter. It went down and stayed down. People in Texas said, I'm never buying property in Texas again. How we got our start is in 89, and we came out from California, started buying. Then we had a client who said, hey, we've got $120 million, go invest that. So between 91 and 94, we paid cash for properties. And the average price was about $22,000 per unit for properties that were 5 years old. Okay, that was a killer deal. Same thing in 2008 then, that one went down. If you had cash, you could buy a lot because you couldn't get debt. Same thing, 2011, same scenario. 2012, 2013, 2014. It was the same deal. Couldn't get bank debt. Cash was hard to come by. People didn't want to invest, but you could still find great deals. And those were the times to buy great deals. I've asked this before. If you can go back in time and invest, what year would you want to go back and invest in? Yeah, more on this chart. 2014, yeah. That would have been about the best time. But if you were in 12, 13, and 14, you still killed it, okay? 2015, everything started lining up. Money came in. 2016, same thing. 2017, everything's lining up and going great, plus the tax benefits. 2008, everything. Now, 2019, we had a problem because there was no equity capture left. There was no value add deals became very rare. There wasn't something that you could go in there and buy below market at that time because everybody was flooding the market. You know syndicators that they probably came in about 2018. That's when they really started picking up with everybody raising money. 2017, again, big tax break, shot it up even higher. 2018, it's going higher. Then 2019, again, no equity capture. 2020, no equity capture. And in 2020, I've got an asterisk on my leverage, okay? Because Fannie Mae, who's conservative, said, here, this is the most we'll loan. Bridge lenders came into the market and they caused what I call the bridge loan bubble. And basically they came in there and a bridge loan, they loan you 80% of the purchase price based on the value 3 years from now. Okay, so they're going back and saying, okay, yes, if you bought here, the value 3 years, you're good. Well, they caused a bubble, and I'll show you some more graphs on that. So that's the whole reason you could still get leverage, but that was because of bridge loans. 2020, COVID, people moved. COVID was just it was a lot scarier. It was not as bad as we thought it was going to be. 2021 went freaking crazy with all the money that got flooded into the market. Everybody's getting payments. Everybody's doing that. They're moving up. Rents are going up. Inflation starts. 2020 hits. 22. Interest rates go up. Property values go down. Leverage is gone. Bridge lenders are gone. They're back out of it. If you want agency debt, you're getting about 50, 60% loan to purchase price. People are afraid to invest because the whole market went down and they don't want to lose. And so that's the whole thing. Be greedy when others are fearful. That's when they're greedy is 2022. When they're fearful, 2022. And now we're in 2023. Okay. Interest rates went way up. We're pretty close to the top of interest rate rising, I think. Maybe one or two small bumps because if they go too much, they're going to cause a recession. But now income it's hard to get. Because if you're going to get debt on these, your debt is a lot more expensive. And there's still a big, anybody trade stocks? Who trades stocks? Okay. Bid and ask. The difference between bid and ask has grown substantially because owners said, hey, wait a minute, I need this amount for the property. And look, it's only worth this. People we bought the mark from were realistic. They marked it to where the market would sell, which was very good of them, whereas a lot of people, they can't. There's a lot of people getting hurt. There's one property, who's heard of tides? Okay. What's that? Roscoe took them all over? Did they? I did not know that. But one example, because you know about the guy that raised $70 million, bought a portfolio, and 14 months later got foreclosed on. $70 million wiped out like that. This one particular property, they paid $250 million for it, $50 million in equity, $200 million loan in default, and the property is only worth $125 million. Okay, so there's a lot of people getting hurt, and that's why we're very specific on what we buy to make sure that we're buying right. Now, we're not immune to what the market does. Back in 2016, 17, 18, 19, 20, 21, it was really cap rate compression that increased the value of the properties. Cash flow wasn't a lot higher, but the cap rate compression increased the value of the properties. And so any idiot that went out and bought a property and didn't do anything to it would wait 6 months and sell it for a profit. I'll show you that in a second. So what I'm trying to say is, if we look at this, where we are in 2023, 2 X's, 3 check marks, that's pretty much where we were in 10, 11, and 12. And 13 and 14. So however you want to look at that, that's the reason, one of the reasons why I think it's good to buy. Put it in graph form. Okay. These are Class A properties. Okay. For those of you who can't see, the orange line is central business district. Blue line's urban, green is suburban. Okay. These are Class A properties. Okay. And this is from CoStar, who tracks all this. Now the black vertical line, that's where we are right now. From now on, that's the forecast. Okay, and you can see these, you can't see the little hash marks. This is after Q2 of 2023. Okay, so they've got 24, 25, 26, 27, 28. I really like, this really illustrates what I was talking about. Going up there, this spike, that's the bridge loan bubble right there. That's what I called it. Okay, the bridge loan bubble. Basically, it helped out sellers because people could borrow more money to pay more money for the properties. So that bridge loan bubble's what popped. What caused all the problem is that easy money from bridge loans. Okay, and so now we're back down here. The forecast is just a little dip and then going up. Okay, so again, another big reason to buy. That's the forecast for Class A. What's funny, okay, Class A, Class B properties, same chart, right? Class C. Now the only thing different on this one is the orange line. Class C properties in central business district. What happened here? 2020? COVID. So C quality properties took a hit because everybody's moving out of the urban core and getting out of the suburban, get away from it. Plus so many job losses, they had to get out of there anyway. So that was the only difference in Class C. Let me go back to Class A real quick.
So the question, what's the rationale for this before 2023?
What's the rationale for this? Okay, if you look at this, this should have gone up and stayed solid. Okay, that right there is bridge loans came in there, gave free money. I don't want to say free money. They gave easy money to buy properties, which drove prices up. Income was going up because everybody was getting rental assistance, and they didn't really care. They could pay more on rent, so some people went up to other properties. And so that's what had it jump up. All this was, that dip, is the correction getting it back to where it should be. And it's all driven, it's all economic driven. It's interesting. 2022, right here, that's where they were offered 110 million for the mark. Okay? Which that is about 310,000 a unit, which is what they were offered. And now it's down here in the, and actually we're paying less than that, in the 250 range. We're paying right about here for the mark. Okay. Actually, I'm sorry I did that wrong. That's completely wrong. I know. I was looking at the wrong line. Okay. So yeah, we've got to go to the suburban. They were at the 250 mark, and now it's down at 197. Sorry, wrong line. Screwed that up. But it gives a good illustration of where we are and why we want to buy. Okay. Who thinks now is a good time to buy? Okay. Good time to invest. Yeah.
So when you say Class A, this is just property that you guys are buying, not new construction, or property?
This is a report from CoStar, and what they're talking about, Class A properties, basically new construction. Call it that. Class B properties are, well,
Mid-80s to mid-90s to late 90s, although there wasn't a whole lot of apartment building in the 90s here.
but now, because I would class, that's what we used to say is Bs starting in the 80s. I would say Bs are really in the 90s now because of the age.
But the only reason I lumped the 80s in there is because there was so little construction in the 90s.
So little construction in the early 90s, absolutely. Okay, so those are reasons to buy now.
Darwin, if you don't mind indulging me,
Jump in here.
this one right here. This is one of the reasons that we here at, who said that? Leave it. One of the reasons we made a conscious decision here and right during COVID, right after COVID, is that this trough is not only the flight from the urban core, but those are C-class properties that were hit very hard by COVID. These are the primarily workforce housing, blue collar, the butcher, the baker, the candlestick maker. These people could not zoom in to work. These people had jobs they had to leave the house for, and a lot of those jobs were deemed non-essential, and they lost their jobs. And that's why we see this that you don't see in the other charts, and made a huge difference. And so we made a conscious decision never to go back into this class of real estate unless it's an absolute steal, because not only is it a challenge to operate these properties given the age and the physical plant. Take the cast iron waistlines, which have been Amber Vista. Okay, that's between us. Very difficult to manage properties like that. So we said no more of this. If you've been around long enough, we have been upgrading all of our acquisitions now, and we're really shooting for, it doesn't have to be new construction, but newer construction. In fact, we are looking very heavily at one right now that's 2016, and we're hoping to have more information on that next week. But that to us is stay away from. So if you're out there being pitched anything from the 60s, 70s, and early 80s, run, don't walk from that property.
Here's another reason why we did that. If this is Class A properties, Class B properties, and Class C properties, and these are cap rates, there was a big gap between the C's and the B's and the B's and the A's. As so many people came into the market, that got squeezed. So the same cap rate for a C quality property as an A quality property, why would you buy a C? There's too much risk on it, so we said forget about that. Okay. Any comments on any of those graphs?
I have a question about the orange line was, what'd you call it?
Core. That's downtown.
And then what's the difference in urban and downtown?
Okay, let's say Central Business District is downtown Dallas, downtown Fort Worth. Then you have the bigger rings, think 635 or even George Bush for urban, and then And then the green is suburban, yeah. Okay. Any other questions? Okay. That's where we are in the market and why we are happy about buying. I mentioned in one of the previous meetings, we thought, how do we adjust our buying strategy? And we started going through all the different points we look at, and we said, wait a minute, we don't need to change anything. We have the same strategy as we did 10 years ago, which is why we didn't buy anything. The only slight change that we have is that, going back to this one, I didn't buy as much in those years because there wasn't as much income, okay? So now I'm saying, okay, if we're really gonna be buying now, can't be as hung up on making sure that there's really good income, because I know you guys all look at your portfolios and you're saying, wait a minute, why should I invest in that, not make any cash flow? I can stick it in a CD and make 5% or even more, okay? So it's a competition between where you put your money, because you've got plenty of options. You might say, I want to stay completely liquid, put it in there and earn 5%. But I think the new inflation number that I was reading about on real inflation was like 10% still. So you're still losing money overall. In real estate, it keeps up with inflation, which is why you want to be there. But so right now we're not quite as aggressive on buying properties with income, with good cash flow, as we are buying good deals, okay? Because back here, if you bought good deals, you made a killing, right? You want to go back down to 12, 13, 14? Same scenario.